Well, welcome. I hope that you've had a good day today, and this is an opportunity for you to sit back and enjoy a little bit of our presentation that we did on Saturday, October the 8th at Star Mountain Forest Country Club. I think I am letting you see me right now with a little virtual screen behind me. This is a picture I took one time when I was going 65 miles an hour down the road and realized that my odometer was getting ready to turn to 56,789 miles. So that's 56789. I just like that kind of funny stuff with numbers. So I took this picture and I thought I'd use it as my virtual background today. I think I was near Lexington, North Carolina, headed down to Charlotte or Fort Mill. So I'll move this off the screen, I hope, and so it won't be distracting to you. And we'll get started with our presentation today called Unprecedented. And you know, a lot is happening right now. As we're recording this, it is October the 8th of 2022. There's a lot that's happening all at once. I get it. There's 24-hour news telling us why it's all going to go down the tubes, and it seems like we're in uncharted waters. You kind of get one thing solved and then another thing pops up. You don't solve anything and you just add another issue on top. It just keeps on snowballing. So today I want to take a very apolitical approach. I don't want to go down any roads that are not necessary because we're seeing enough things go off the rails right now to the left and to the right. So but as we look at the media, as we consume media, whatever, and you filter your sources where you're getting information, you're digesting the realities that you're hearing, it's good to get a little dose of perspective, and I think that will help. So that's what we're going to be doing today when we look at this little presentation called Unprecedented. So why don't we start with, what does unprecedented mean? It is something that you've never seen before. It's new. It's there's no precedence for it, and all this kind of stuff is driven by breaking news. The news media just won't leave us alone. It's sensationalized constantly, and it certainly has an impact on how we view our money and what we should do with it. Makes us think that we know something about something that's going on, so we should do something because of that. So by way of example, some of the things that we're hearing right now that are considered to be unprecedented would be like the sovereign nation defaults on their debt. You've got Russia, you've got Ukraine, Argentina, Venezuela. There's even talk of a U.S. default if our debt ceiling isn't raised periodically. And it happens again and again and again. And then this is the top issue that is facing most Americans right now. We think in terms of this a lot. And it has a very direct impact on our investing and on our investments and the need to have our money grow and do what we plan for it to do. And then, of course, we just left a war in Afghanistan, walked across the street into one in Ukraine against a superpower like Russia. No matter what your position is on the war, how you feel about it, I think we can reasonably say that no war is better than war. And it would be nice to have a little breathing room on this kind of thing. Market declines. When we're in them, they sting, and they sting really bad sometimes. But we need to hang in there because we know that panic during a market correction is just a wealth transfer eventually between people that are disciplined and people that are undisciplined. We have a lot of short memory on this stuff. The one that kicked off the pandemic a few years ago feels like it was forever, but it is like no one remembers how bad it really was. And we lived all through it. All of us lived through it just fine. Another thing that's unprecedented today that we hear about is opportunity. There's unreasonable opportunities that come along and they pop up when everything looks really bad, like Bitcoin or ARK Fund, or we read about the rich dad, poor dad commercials and silver. There's always something, and there'll be something next year, something tomorrow. It just goes on and on. this thing, it won't go away. Anyone else want to just move on and forget this? And then you've got interest rate hikes. The Fed is making some really substantial moves. How does that affect our fixed income, our bonds in our portfolios? It can be scary stuff. Another thing is is unprecedented, at least we hear that it's unprecedented, is bubbles. See, not everything is crashing. And when it isn't, all we can think about is that it probably will at some point. It's forming a bubble. It's going to burst at some point. Many asset classes have seen declines. And those that haven't, like housing and that sort of thing, that haven't had declines yet, we hear about it possibly happening coming up or in the future. So what we're dealing with now is it all that different? Is it really? Is it really unprecedented? So, like I said, perspective will help. And here's, I hope, is going to be a healthy dose of perspective, because none of this is new. And if we're honest with ourselves, a little bit of a student of history, that kind of thing, then we can look at it and say, hey, maybe this isn't so bad. It's not to say that it's good, but it may not be that bad. So let's revisit some things that we just went through and look at them with a little perspective. So we'll start off with sovereign nation defaults. We worry about defaults, most critically here in the US, because it affects us directly. And periodically we hear that we've got to raise the debt ceiling or else a default's imminent. And if it were to happen, what would it be? Of course, it's a catastrophe, right? But it happens a lot. This is a normal part of global capitalism. I was just looking from 1990 to 2022 at some of the nations that have defaulted in some form or fashion on their sovereign debt, on their government issued debt, their bonds, if you will, government securities. And there's a lot of them here. It's a normal part of global capitalism. It happens. And even though it's a long time ago, it's happened to us too. And we got through it. So seems like everything's going to be all right relative to sovereign debt defaults. How about inflation? Well, it's the single biggest concern for everybody right now. And you can see here, one of the big areas is food in the US. I mentioned today that there's a guy in one of my friend's offices that sells eggs, and he has been selling them for some time at $3 a dozen. But recently, he started selling them for $4 a dozen. Guess what? Eggs are up 33%, as are a lot of other things. And, the 70s, when we look back there, we had inflation going to the end of the world, and your money is going to be worthless, was what all the advertising or commentary was about. And it was bad. Inflation was bad. You may recall under the Nixon administration when we had price controls. And then with Gerald Ford, there was the campaign called Whip Inflation Now. He had these little buttons with WIN, Whip Inflation Now on them. And of course, we went on into the Carter years. And I don't know why I'm using presidents as ways to mark things, but I guess that's easy to do. But you go into the Carter years, inflation picked up even worse. And then into the early Reagan years before they kind of got it under control a little bit. But you kept on hearing, I mean, it's happening all over the world, and it's going to eat us alive and destroy us. And then that was in the 70s. If you went back a few decades, in the New Deal back in the 1930s. It was all about government spending and getting out of a recession. And guess what? Sound familiar? Inflation went crazy. We've been having a lot of government spending to get us out of a pandemic and out of a recession and all kind of stuff like that over the last decade or so. And inflation is finally now starting to pick up pretty significantly. This is the one thing that people really feel. And when it's out of control, it affects everything. It's been out of control. But it's not like this. What we're going through is not like what it was back in the 70s when we had long lines to get gas. I can remember sitting in a line to get gas at this time when I was in high school, and almost thinking I was going to run out of gas, waiting to get to the pump to put more gas in. It was a pretty severe time when we had the oil embargo from the Middle East. And every other day you could buy gas. If your license tag ended with an even number, you bought on even days, odd number, you bought on odd days. Pretty bad. A lot worse than it is now. So I'd say that everything's probably going to be all right. It doesn't look as bad as we might feel that it is today. We've been through worse, and we came out on the other side. So what about the unprecedents of war? Putin, we're worried he's going to start a chain of events that would lead to nuclear war, strategic weapons, tactical nuclear weapons, whatever. And he's always carting them out to show his symbols of threat and all that kind of stuff to scare people and maybe back them off. And we're having some pretty sensational pictures come out of Ukraine of all the destruction that's been going on there. And it's very, very ugly. And I don't want to minimize the human pain and toil or toll here. It is pretty bad. But if we look back to the 60s, we were pretty legitimately close to a nuclear war then. There were missiles in Italy and Turkey that were pointed at Russia. There were missiles from Russia sitting 90 miles offshore in Cuba pointed at us. The finger was on the button, and it was scary stuff. I can remember going in a bomb shelter during that time as a kid and just looking around, not going into shelter, but just to see it and see how you do shelter if need be. But other times, go back a few decades prior to that, you had World War II that had occurred, and we had a total of over 50 million military and civilian fatalities. And then related to that, you had another 20 to 30 million war-related diseases and famine, people starving to death because of the war ruining crops and so forth. And we went through that war, and it meant losing people, and I mean lots of people in that war. And then, of course, we dropped a bomb. We dropped a nuclear bomb. 130,000 people wiped out in a flash. Let that sink in a little bit. And then, of course, you go back to World War I, a little bit further. You had 21 million people that were killed and wounded, 10 million civilians, and they're just huge numbers of people that today, if we think about that, I mean, I can remember in the Vietnam War, tens of thousands, and even now today, we don't hear about that. I don't remember the numbers, but during the Iraq Wars, seems like, it's just a very few numbers of military deaths that occurred, and Afghanistan lasted much longer than that. But again, just, a few numbers a day, whereas say during the Vietnam War, during World War II, it was daily humongous numbers being reported. So here's a little perspective. What we're going through right now is admittedly not good, but this is how we fight now. Now we drop non-explosive bombs that have knives on the head and or the front of the missile, and we drop it on the terrorist that's sitting on his balcony drinking tea in Afghanistan, and the people inside the house 30 feet away, they're not even harmed. Our people, our soldiers or whatever, we don't even have to be in the vicinity. We could even be here in the US doing this somewhere else. It's totally different. The conflicts that we're having are not ideal, but it's been way worse in the past. So I think relative to this, seems like everything's going to be all right. Then you have market declines. Back in 2020, at the beginning of the pandemic, you had the market drop 30% in just 2 months. Hard to believe that happened, and we lived through it. Back at that time too, we started hearing about this portfolio mix called a 60-40 portfolio, which is just a prudent way to invest that it was no longer something that could be considered as a useful way to structure your investments. So from 1926 to 2020, almost 100 years, the portfolio was fine, but then it was not fine. And you started seeing things like this. Is the 60-40 mix dead? Articles in news magazines or periodicals or whatever. So that's in October of 2021. Just go forward 9 months. Hey, it's back. It'll make a comeback in July of 2022. This kind of stuff just goes on and on. And, just a decade prior to that, you had what's called the lost decade, or the dead decade, as it was often called, where you had zero return on U.S. equities for a decade. And again, that wasn't that long ago. September of 98 to March of 2009, this dead decade where you started out with $100,000 in your portfolio, you saw it go up from 98 to early 2000, then it dropped until the end of 2002. Picked back up, went up to 2008, dropped again off to March of 2009. Ended up where you're below your 100,000 there, so you lost that decade as far as the S&P 500 is concerned. But go back a few decades and you get to 1979. And what do you hear? Well, this Business Week magazine says that equities or stocks, they're dead. Inflation is destroying the stock market, and the market's not going to come back. Remember that date, August 13th, 1979. Well, everybody thought it's over. Inflation is going to ruin this country, and it was painful. It was worse than inflation today, and the market declines were worse than they are today. But how many times are we going to declare stocks are dead? We got through it, and then guess what happened? The 80s were awesome. The 80s brought us awesome clothes, awesome hair bands, awesome movies, and awesome returns. Yeah, equities were dead there in August of 1979, but then from January 1 of 1980 through December 31 of 1989, during that 10 years, if you had $100,000 invested in the market, and this is the total market, is all the sizes of large, small, growth, value, the whole bit in the U.S., your 100,000 grew to 468,000 in that time frame. That's pretty awesome. So seems to look like, things have looked worse in the past, but everything's going to be all right this time too. So now let's just don't talk about scary stuff and fear. Let's don't forget about the greed side of the equation. There's always going to be the next hot thing that comes along and says, come to me. No time's different, no market's different. There's always somebody out there that's hawking something that sounds really good to pull people in. Don't fall for the too good to be true deal. And we're most at risk during the tougher times because we're looking for a way to get out of the mess we're in. And we have that feeling again that because something's going on and we know something's going on, we need to do something. So, you think about how attractive were huge companies, mega cap portfolios in the last 5 years. And so you heard a lot about these things, the FANG stocks, Facebook, Amazon, I don't know, Netflix, Google, what have you. And you go back a little bit in time, you had Peter Lynch, and he was the best until he wasn't. And most investors in the Magellan Fund, they never saw the returns that were so enticing because they got in after they heard about it rather than when he started out and nobody knew about him. And of course, then he quit. And when we talk about great investors, who doesn't think about the Oracle of Omaha? And he's great sometimes, and sometimes he's not. Over the last 15 years or so, he's lagged the market pretty heavily. And then we have this person. This is the Kathy Wood, she's the manager of the ARK Fund, ARKK, and it's been touting an average return of 31% backaways per year. This is how the news media showed it, that for the last 3 years, her fund was up 165%, and other things just were not. But then this is what really things look like. In April of 2020, at the end of the or at the bottom, I should say, of the crash that happened back then, her fund, if she had their initial money that was in the portfolio, it looks like it was maybe around $10,000. It skyrocketed over the next year to slightly over 300,000. 300, I said 100,000, $10,000. If you had 10,000 in it, I should say, your money would have rocketed to $300,000. At the peak there, and I don't know if you can see this if I point at it like this. Let me see if I can get a little button here. Oh, mercy, I want to spot. There we go. I want to spotlight, and let's format it. Okay, so right there at the peak, right up here, she had $6 billion invested in the portfolio. And then people that were in that portfolio, they wrote it right all the way down till January of this year, and it was back down to $100,000, which is where the S&P ended up starting at the same point. But the money that she had invested here was $20 billion. So between here at actually, I think it was 21 billion. Here at 6 billion, wrote it down to 20 billion. Now, my question to you is this: how do you ride something down from 6 billion to a bigger number, 20 billion, $15 billion more? Well, this is how you do it. You have all of this going on, and then people start to talk about it, and this is where they jump in, right up here. And then, so a lot of money pours into this thing up in this range, right in this range. And then when the ride starts, maybe you had 100 billion in there, but then it drops 2/3 of its value, and now you got only 20 billion left. That's how you go from 6 billion to 20 billion and still lose a ton of money. It's pretty interesting, isn't it? Let me see if I can erase this mess, because I think it's gonna continue. Yeah, let's go. Here we go. All right. So we'll get that off the screen, and we'll continue on. And in fact, even after all that has happened, what do you think they got? After these awful returns, or an awful run, when it drops so much, she's still out there forecasting that they're going to get 50% returns for the ARK Fund. So even though the evidence isn't there, they're still promoting these opportunities that things are going to really take off and be great. So, with all of this mess, I think we can consider that, hey, it's not as bad as it has been. Everything's going to be all right. So now we have the unprecedented pandemic, and pandemics aren't new. They are things that we face globally. We've gotten through them time and time again. They're not good, but they're not the end. And so these are some examples: some cholera, some plague, meningitis, Nipah virus, dengue fever, cholera, SARS coronavirus, yellow fever, dengue fever again, bubonic plague, one of my favorites, yes. Hand, foot, and mouth disease, flu pandemics, H1N1, I think that was, mumps and measles, Ebola, swine flu, Zika virus, and of course, the coronavirus, COVID-19. All of that, $10,000 invested in January of 1990, and then go through all of these different plagues or diseases and pandemics. At the end of 2020, that $10,000 had become 21 times more at $212,000. So I think we can say that probably with our little pandemic we just had, everything's going to be all right. I'm not trying to minimize it, just saying it's something that we see all the time. I think will be okay. So next we have interest rate hikes. And you can see here that the Fed has raised rates recently. You see June of 2022 that they bumped it up 0.75%. I think they did it again in September. But look at what happened back in the 80s. I bought my first house in 1979 at an 8.5% interest rate. And the Fed funds rates, I mean, they were spiking 1%, 2%, 4%, at one time. And then they come down over time. We've had a really nice long run with low interest rates, a little bump up back here in 2016 to 20, but then we dropped back down when we had that last crash in early 2020, and now we're starting to get a little bump up. The Fed, they're big, but they're not unprecedented. Yeah, rates are going up, but by historical standards, we're really low. So I think everything's going to be all right there. And then we have the unprecedents of bubbles. When things are bad, we think they're going to get worse. And when things are good, we wait for them to get bad. And the media, they're sadists, they fuel our financial masochism where we want to beat ourselves up over stuff. So there was a time in the 1600s when there was this little tulip bulb thing going on where they were so overvalued that a tulip bulb would cost you more than a house would cost. The price of bulbs, they just kept going up to these incredible and unthinkable levels. And then the market crashed. And you might think, yeah, but these people were morons. They didn't have financial sophistication back in the 1600s. This could never happen today. Maybe. How about this? What do you pay for shoes? When I was a kid, $100 for a shoe, I don't think it was even possible. It was outrageous if it was. But these are the shoes that we are seeing today. Then this is kind of, quote, normal. Normal enough that you see it everywhere, but it doesn't end here. Here's this Yeezy foam shoe for $360. How about a Kobe Grinch, $1,065? Doesn't end there. How about the Air Jordan 10 Off-White Chicago, $13,000? And you think that's bad, but I've got even more. How about a Freddy Krueger original, $30,000 for a tennis shoe? Well, the stupid Dutch 400 years ago, maybe they weren't morons after all. It doesn't seem like there's much difference to me in the tulip bulb thing and the shoes or this Bitcoin Ethereum stuff and all the craziness of that. Or how about the tech bubble back in the early 2000s after a run up from 1995 where you had these companies that had revenue but no earnings. They were spending more money than they were bringing in, but yet their stock prices were high until they weren't, and they crashed in 2000. Or we can go back a little bit to 2008 when we had a 20% decline in housing. So housing crisis, crazy stuff with shoes, all that kind of stuff, tulip bulbs. I don't think it's that bad that everything's not going to be all right. So we've been through the bubbles, and if we were disciplined, we probably avoided the brunt of it. But if we didn't, we came out the other side, and here we are today. So is it worth checking ourselves and asking, is this really different before we let our emotions get the better of us? The answer is no and yes. No, in that we've seen a lot of similar things in the past. Yes, in that it's always a little different. And that's the risk that we assume and that we really want, because it's the risk that we're compensated for over the long run. So is it unprecedented? Well, I'd have to say really the only thing going on today that's unprecedented is the use of the word unprecedented. It's spiked dramatically in the last year or so. And history has a way of repeating itself. We've got the same themes going on that we had post-war 1920, fighting police brutality and wages and work weeks and all kinds of stuff. If you hear anything like this that says this time it's different, or it's the new normal, or times are so uncertain, or we're in uncharted waters. We've never been here before. Now more than ever, you need to do whatever, run away. The future is unknown, it's unknowable, it's uncertain, it's just a part of it, and it's okay. The uncertainty is the risk that you get compensated for over the long term. It's good for us to have uncertainty in the long run. You don't get paid for placing bets on things that you know the outcome of. Like you put money in the bank, you know pretty much what the outcome is going to be. Your money's going to be there. It's not going down in dollar amounts. It might go down in value because of inflation, but you're going to get a small pittance of interest. And that's because you know what's going to happen to the thing. There's no risk. You don't get any investment returns if you have no risk investing. So the world's not coming to an end. And if it does, it matters little what your portfolio looks like. So for now, I would argue that despite what we're being told, that just like I found in a Luray Caverns sign, I'm an old man now. I've seen lots of trouble. Most of it never happened. So we could pretty well say that yeah, everything's pretty awesome. The country's gotten through all these hard times in the past, and so did the stock market. So next time you find yourself thinking this is the real thing and we're in big trouble, take a deep breath. Optimism in the market is not naivety. It is realistic. The media, the bullhorn, whatever, there is telling you that this optimism is dumb, but it is really the only thing that makes sense. And that's why we continue to invest with evidence. I hope you've enjoyed this. If you have questions or comments, please feel free to reach out to us. You can schedule a meeting with us if you go to www.talks2mike.com. That's TALKSTOMIKE. And you can schedule a meeting with me, a phone meeting, and we can schedule an in-person meeting if you'd like, or just pick up the phone and call us at our office. You can reach me on my direct line at 336-706-2605. Glad to answer your questions, glad to entertain your comments and thoughts, and share some ideas with you. Thanks again. It's been great sharing this time with you, and look forward to seeing you next time. And by the way, we are having our next event in Huntersville, North Carolina, just north of Charlotte. On November 10th, there will be a luncheon, and our topic will be when the market is crazy, what do I do? And we'll be looking at a little bit of academic evidence for what to do there. Then be sure and mark your calendar for December 3rd in High Point, North Carolina. And this is at a new venue, the High Point Country Club, where we'll be having our annual Christmas party. We'd love to have you come and be with us. So you'll be hearing about more of that with our newsletter. If you're not on our newsletter, let us know. We'll be glad to get you on there. It comes out every Tuesday by email. And if you'd like to be included in the invitations for future events, just let us know that. Again, you can reach out to us at 336-706-2605. And we look forward to it. Thanks so much.